You mark your zones and you have your supply, your demand, and you think you have an edge, and then it fails. Now, the reason behind this is because these supply zones and demand zones require certain criteria for them to be validated. And if they're not, they become something that I call smart money trap. Now, this is how the institutions use your edge against you. And in this video, we're gonna flip the script so you can use that edge in your favor. So now we're gonna move on to the charts where you're gonna see real-time examples. As I always say, it's very important for you to understand that liquidity is the fuel of the market. This is what I always say, right? And these traps are made for more liquidity to be printed in the market and then be tackled for the right move to go ahead and get started. So I'm gonna go ahead and do some drawings over here for you to kind of understand the narrative, and then we're gonna go ahead and I'll give you two examples of how smart money traps could be in the market, right? So if we want to focus on ranges in the market, maybe determining the swing highs and the swing lows, maybe this would be one range, maybe from this push, and then you would be having a retest to the upside to then come back to the original supply zone to take a push to the lower low. As we all know, this could be a supply zone over here. We would extend this supply zone. Now that this is a supply zone, we already know that this have already caused a break of structure, maybe with some movement to the left. And once we have waited to the supply zone to be tapped into, we are now trading the lower low. And this is how the market moves. This is how we want the market to move, but unfortunately, it's not that easy. Now, what I'm going to do is I'm going to explain to you that we have to operate on our edge. And our edge is basically knowing when that supply zone is valid, when it's not valid, when it could be a supply zone, when it can't be a supply zone. And so what really happens is for the smart money traps is we end up having no break of structure, but we still want to mark it as a supply zone because we think that this is the right move. But this is how we get trapped. So you have a push to the downside, and then you have a retest, and then you have another push to the downside. Maybe it's a wick over here with no body closure over it, and then you have a retracement, and then you think that right now this is your new supply zone. So when you have a tap into it, you'd want to go ahead and trade the lower low, right? This could be another narrative. Maybe this supply zone over here, and let's say the one over here has already been tapped into, served its purpose. So what happens over here is you get a reaction, but then quickly later on it takes you out. Basically, this becomes a smart money trap over here. Now, this could sound like it's confusing. We're going to go ahead and do some chart examples, but before we go ahead and do that, I would want to show you it from the downside just so you know. So let's say over here, we have a push to the upside and we have a retest. So this supply zone over here this demand zone over here has already served its purpose because now over here, this demand zone has been tapped into. We are now maybe trading a higher high. Now, what basically happens is that over here, you have a retest, maybe to another point over here, filling another imbalance, and then you have a push over here to the upside. But there is no break of structure over here. Maybe it wicks into it, so it could show you that it's maybe a little bit above it. And then once you're having another retest, you think that this is another demand zone over here, which in this case, it's not. But what price does is it will give you a reaction for you to think that you can start entering more and more positions over here, and you think you're having it the right way, and then it takes you out. This portion over here is called a smart money trap. So I would want you to know this because sometimes when you're in a trade and you feel like price is retesting, this is how price moves. We have a push, we have a retest, and we have a push to the downside. When this is happening, you know that smart money traps are playing out. Now, if you want to go to the charts, you're going to be able to see how you get trapped and how you can avoid it. So one example I'm going to show you is where the supply zone doesn't get tapped into. And another example I'm going to show you where the supply zone is maybe high above over here. You have a smart money trap somewhere over here, gives a reaction. People will be selling from this portion over here and then takes them out until it retraces to our original supply zone so we can trade the better portion. First example we want to see is we have a break of structure at this point over here. So let me go ahead and mark everything. This would be our break of structure. So we would have that be over here, and what caused this break of structure is this supply zone at this portion over here, right? So this supply zone, we were waiting for it to get a tap into it, but before we have done it on live price action, you cannot see this portion. So what happens is you get internal price action in between, and as you can see, there's another push from this portion all the way down here. As you can see, there's no clear break of structure on this portion, and price did not break through it. So what happens is this over here becomes a smart money trap. And look at what happens. Price comes back to it over here, taps into it, gives you a reaction to say, okay, maybe you can start selling. And once people have more positions over here, more stop losses are resided over here. So now we have more liquidity over here. Now that we know we have imbalance over here, we know that the real move is about to happen from this portion. And as we spoken before, we wait for the smart money trap to be taken out, and then we wait for the original retracement, comes back to our supply zone, fills our imbalance, and we trade the lower low. Now this could be a potential trade. You look at this portion over here, you take the sell a little bit over your supply zone, and you trade the lower low, and this would be a 5% trade. So over here you would be making 5% back. You enter with $1,000, you make $5,210. And this is a trade. This is a trade after having all of these confluences together, knowing that it's a bearish trend, obviously waiting for your time frames, all that kind of stuff. Now we're gonna go to another portion where smart money traps could be avoided. Okay, so over here, for example, also we need to always determine the range. So as you can see, it's very clear that you have this to this as your swing high, swing low. This is the main push. So we're obviously waiting for a retracement to then take a trade to the downside. Sometimes we can maybe not take a trade because it's not clear. Maybe there's more imbalance residing over here, which would lead for me to not take the trade from this portion. But also, most importantly, is you see how the smart money traps operate. And the way they operate is that you determine that these are the swings, right? We've established this already. Now that we have a push to the upside and you have imbalance residing under, a lot of people would be having this be a demand zone, right? And this is fair. I mean, it looks like it just broke the structure from this portion over here, but we have to always remember the main push. There's imbalance at the extreme. Price could very easily climb up, tap into this one, and take you out from this trade as well. So if you're able to kind of avoid the smart money traps when they're not at your not in your arsenal, and you can take advantage of them when you're in a trade or when you're kind of having a trade cooking up, this is where you would want to be in the market. This would be a smart money trap simply because what we spoke about. You would have a push to the upside, imbalance over here, so you'd want price to come back to it. And what happens is it does give you a reaction. It shows you that yes, we are going back to the upside. It gives you the doji candlestick. It gives you the bullish engulfing. It gives you this push to the upside. And imagine how many people are entering trades over here, how many buy positions are being situated, and how many stop loss are situated, because you know we put our stop losses right under our demand zone. So what happens is you get a push to the upside. Remember the push from the downside, which is the main push. You get a retracement, you get a push back to the smart money trap. This over here gives you a reaction. Everybody starts entering over here, and then you're taken out. And this is it for the smart money trap. I don't want you to complicate it more than it is. It's just that it gives you a reaction, no break of structure, and after that it invites you in and then it takes you out. You don't have to complicate it more than that. This is what it is. Now, if you're in a trade and you see a smart money trap play out, you know that you're good, because you know that it's having a push to the upside, inviting more people in, but you've already had your precise entry. You don't have to worry about anything. So as long as price is creating lower lows without visiting previous imbalances, you are good to go. And that is it for today's video. I hope you enjoyed it. I would love for you to subscribe to this channel since it's a new channel. I would love to know any other topics for you to kind of refine or tune your strategy. I'm all here for it. And as always, I'll see you in the next one. Thank you for watching.